Hey, good evening, everyone. Marty Mazzora here, February 25th, 2022, Friday, with your weekly macro update. I thought about updating our technical analysis, at least of the stock market, because a lot's happened since Wednesday, as you've noticed, since we did the last one. But I've got so much to show you here, and I don't want to make it too long, that I will just focus on the inputs to our macro analysis this week on this video, and probably over the weekend I'll circle back with an updated technical analysis. So in front of you is our PWA macro index. Boy, we continue to roll over. Pretty notable drop this week, down to 20 and something in terms of our overall macro score. I'll tell you though that still is comfortably above what we would consider recessionary conditions. We just think the setup, as I continue to preach here, is dramatically different than it's been throughout the I'm going to say this existing bull market. In terms of media's definition of a bear market, we had a bear market in 2020. I think it has to last longer than 3 weeks, right? And actually do something in terms of purging excesses. And this last experience, as we've discussed here, was precisely the opposite. Not only did we not purge excesses, we added to them in a historic way with the trillions in stimulus and so on. But here we are today, and I think to some degree because of that, and if not entirely because of that, all that stimulus, we sit here having experienced, the briefest recession in history, and probably the briefest bear market, in fact, I'm sure, in history. So as I've said before, there's some artificiality, to what we've seen here, but it is what it is, and we take the data for what it is as well, and allow it to instruct us accordingly, although there is a great deal of critical thinking and consideration of context and current setups that we have to apply as we allocate assets going forward. With regard to the current narrative around the Fed, this by itself, and obviously the Fed's economists are looking at a lot of the same data we are, would tell them to think about, how tight they want to get with financial conditions. The problem is that inflation is very problematic. So again, very fluid situation, a very volatile situation, one that we'll stay on top of and communicate our thoughts to you consistently. And as you'll see, as I show you these inputs, it's not all bad. 42% of our inputs are actually scoring positive, 21% are negative, and the rest are neutral. I'll show you what's moved the needle this week and a few that didn't necessarily change score, but that are worth taking a peek at nonetheless. Starting with personal consumption expenditures. So consumer spending rose. Thing is, personal income month over month was actually, call it flat, down a couple of percent year over year. So folks, when you have spending rising but income flat, then one of the things you would look for is, of course, a reduction in the savings rate, which we got right here. So you can see personal savings, consumer savings ratio actually dropped to 6.4. So again, if we had a pickup in spending on a flat income, right, well then we're going to be drawing from savings to do that. You can see that savings are down from these incredible high numbers during the height of COVID. And a lot of economists are actually very bullish because there is so much in savings, some $2 trillion in consumer savings accounts currently, that they think will offset what would be the fiscal drag. As long as consumers continue to feel comfortable enough to get out there and spend money, companies, as I read through the surveys, believe that they will, because by and large, companies, and this is globally, are passing this inflation on to the consumer, or certainly plan to. Mortgage purchase applications, they took another notch down. The 30-year average rate is now north of 4%. We still have healthy price increases. We still have, a relatively tight market. So we don't have a situation where we think residential real estate is about to roll over hard. But clearly, it's safe to say that there's got to be some peaking in that space. At a north of 4% 30-year mortgage rate, For my generation, that's still crazy low, but for today's situation, and when you look at home prices having ramped up the way they are, there's a big cohort there, and that would be that first-time home buyer who's been priced out of this market. And that becomes problematic. Weekly jobless claims were down to 232. That was down on the week. So again, folks, these are not jobs numbers or jobless claims numbers weekly that tell us that we need to be worried about recession anytime soon. U.S. durable goods orders were up year over year, as well as up a bit on a month-on-month basis. CapEx, this is very impressive. So capital expenditures, and this is big. This is really important. It says a lot about sentiment in terms of businesses, if they're really willing to invest in capital, expand their operations. You need more of that. It ultimately leads to more productivity, in the longer term scheme of things. And that can bring down inflation, of course. And so we're seeing it in non-defense new orders. You can see a nice ramp up in ex-aircraft shipments, big increase in capital goods shipments, and in the non-residential spending. You can see that just continues to go up here as well. But again, you don't see that sort of shape in these charts during recessionary periods, right? Here was the big one, the one before that, and so on. So again, this flies in the face of anybody who's calling for recession in the near term. The Chicago Fed National Activity Index, 85 data points that they track. This last month, 58 of them were positive, 27 made negative contributions to the index. And that led to a nice bounce from the previous month to 0.69. So that was a positive score change within our overall index. Heavy truck sales, that's rolling back over a little bit, so that's concerning. And this has been a good indicator, and I think more people should pay attention to this one. It's not perfect, and certainly we don't want to get too excited about 1 month's move here, but it is something we want to pay attention to on a trend basis. And rolling over right here did knock a point off of our overall index. That said, truck tonnage actually, ramped up a little bit. Okay, so obviously that's a positive. And what's also positive, using air quotes, is inflation. Boy, that just continues to ramp up. This is the Fed's preferred measure. This is the PCE deflator, and 6.06%. So for a lot of reasons that I've talked about here on the videos and written a lot about, we do expect a cooling in the growth rate of inflation over the coming months. But we do still have a structurally higher inflation thesis longer term going forward, but not without lots of volatility along the way. The Bloomberg Commodity Index continues just to ramp higher. I've been showing you this one for the last several weeks. Had some resistance right there, have broken through that. We're long-term bullish on commodities, and we think they have quite the ways to run with lots of this along the way. And remember, we've been watching this right off the bottom. We had bull flags, and I promised you we'd have corrective action in here. And sure enough, and falling back to this support level and then bouncing off of that, that's very bullish, but would not surprise me in the least over the coming weeks and months to see this come back and maybe test that line right there as well. But we'll see. It'll be interesting to share this with you as we go. And then lastly, the Baltic Dry Index. This has a lot to do with international construction activity and so on. And the news out of China, folks, is interesting. Just 2 nights ago announced some tax cuts, some new infrastructure initiatives, which is typically China's chosen method of stimulating their economy. So to the extent that China is a component in our emerging markets index, this could be very bullish for that index going forward. Folks, I'll leave it right there. Thank you so much, as always, for watching and listening, and hope you have a wonderful weekend. Take care. Bye-bye.